We have many analysts seeing the S&P with minimal returns. For example, Goldman Sachs believe this year we're going to see a 10% total return, and that includes dividends reinvested. Tom Lee, a very famous analyst constantly on CNBC, he believes, and someone that does gain a lot of respect, that the full year gain of 2025 is going to sit around 9.4%. So today we're looking at companies that actually not only have upside of more than the S&P expected, but also pay some very high dividend yields, which you can see right now in terms of the S&P, how much each company pays. And we're actually going to drill into a sector. We're going to look at the real estate sector, as it is one that does pay some of the highest dividends across the board. Now we're going to look at 10 of them. We're going to run into quite a lot of detail. There also have timestamps if you do want to jump to each stock. And we're going to take a look as well as the valuation. Now first one, Vici Properties. It is down around 7% over the last year. Over the last 5 years, however, up around 14, trading right now at the lower end of the 52-week range. We get a strong buy from Quant, a buy from Wall Street, not far off the strong buy for a 4.5, a buy from Seeking Alpha, and as we said, these will have some very attractive yields. Vici currently offering more than 6%, and we will also show you that it does look to be severely undervalued. Now we'll just briefly show you the earnings expectations. Now understand, over the next 4 quarters, they only anticipate one of them to be growth, and when we do look back over the last 4, they've beaten on 3 of those occasions, 75% track record, and based on the funds from operation, it currently does trade around 10.71 on a forward P to FFO, something similar for stocks. However, we look at that on a P basis. Now a quick look at the valuation grade does give them a B+, and what we typically like to do is compare their price to adjusted funds from operations on a forward-looking basis, which sits at 12.71 against the sector at 15, telling us right now this company is trading at a 15% discount against the sector median. Then we move on to the growth grade, where they get an A+, so some very positive metrics here. Both on an AFFO growth over the last 3 years and the last 5 years, they are considerably higher than the sector medians, 9.5 versus 4.3, 8.5 versus 2.1, so these are some very good signs. Now there are other metrics here we won't spend a lot of time in today's episode looking at, but you can particularly see the different metrics, especially for Vici Properties, which do look very promising. We also like to see the profitability at an A+, and this is largely driven from the cash this company does generate from their operations, 2.31 billion, and when we compare that, significantly higher than the sector comparative at 237 million. Now we will just touch upon a few things today for each of these companies. Now they do have a 50 borderline safe dividend score, which we will touch upon, but we also get an undervaluation signal, and this is largely derived from dividend yield theory, which tells us a company is undervalued when the current yield sits above the 5-year, 5.97, well above the 5.09, and we also notice another undervaluation signal, 12.6 on the forward P to FFO, significantly lower than the 14.5, so that is a very good signal, definitely one that we do look at, making us want to take this further into our analysis. And particularly for this company, we will just touch upon why the borderline safe score exists. Now it is due to the net debt to EBITDA. Now this typically we want to see below 3.5 for hotel REITs, and what you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. It's very high in 2022, but what is good to see is that over the last few years and on a trailing 12 month and over the next 12 months, it is anticipated to come down even lower, so a good sign. But as we typically like to do with these borderline safe scores is just keep an eye on them quarter by quarter, year on year. Now for each one of these companies, we're going to get to our own valuation. For Vici Properties, we get to just under $37, and if you're someone who is maybe new to the channel, when we do our deeper dives, we do run through each model, the inputs and outputs. Today, as we said, we're looking at 10. Jumping straight through then, we always like to apply a margin of safety, 10%, execute on that if it meets our 3 golden criteria. Wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode will buy at around $33, then we keep going till it's near the current trading price, and what we can see in today's episode, not at the 25% level just yet, but around $29, $30, you are getting 20% margin of safety. With Wall Street very bullish, we did see a near strong buy rating, $34, upside of 18%. So unlike the S&P, which is estimated to bring up around 10% in terms of gain, including dividends, as we can see for Vici Properties, a 6% yield or slightly above, 20% margin of safety with 18% upside anticipated by the end of 2025. And as we go along today from these 10 REITs, do give us your thoughts below. Now, before we continue, we just want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away, where you'll be able to gain access to 46 undervalued stocks for the month of January. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of 43 stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. We then move on to realty income, down 9% over the last year. Over the last 10 years, down around 3%. We can see just before that COVID drop, it was trading around $83. Now, right now, it is at the lower end of the 52-week range, a double buy from Seeking Alpha and Wall Street, similar to Vici Properties, a yield over 6%. And when we do take a look at their earnings, they expect every single one over the next 4 quarters to be positive. However, they only have a 25% track record on a historical basis. We do also note their December 2025 forward P to FFO sits at just above. In terms of evaluation, they do sit here at a B-. If we do take a look, again, very similar to Vici Properties, on the forward P to AFFO, it is currently trading at a 16% discount against the sector comparative. Their growth, they do get an A. Again, likewise, both the AFFO on a historical 3-year and 5-year basis does trade above the sector median. And when we do take a look at their profitability, they get an A, and cash from operations are looking very strong, above 3 billion, again, sector comparative, 237 million. In terms of dividend safety, looking better with an 80 safe score. And when we do take a look at dividend yield theory, severe undervaluation, that yield well above the 5-year, as well as the forward P to FFO sitting well below the 5-year. That is a signal that there is some severe undervaluation. Now, in terms of intrinsic value at $68, we will see a very nice margin of safety in today's episode. And as we keep going right now, not at the 30% level just yet. In fact, not at the 25, you would need to wait for around $51, but we can see right now it is sitting somewhere between 20 to 25%, with Wall Street, their price target $63, translating to 19% upside. And one thing we do want to point out with realty income is that their dividend, whilst unlike the majority we'll cover today, actually is paid out on a monthly basis. We then move on to Triple N REIT, down 9% over the last year. Over the last 10 years, down around 14, trading right there towards the lower end of the 52-week range. Just one buy rating from Seeking Alpha with a yield marginally higher than the 6% point. And if we take a look at their earnings moving forwards, they expect 2 of the next 4 to be positive, although we do like to see this 100% track record, and their forward P to FFO does sit at 11.64 for this year. Valuation, they do get a B, as we can see, and as we do go through, there are many different ways and different metrics if you do want to use, but we do notice, based on the forward looking, they are trading at a discount like we have seen from the others, so not only a very attractive yield, but also trading at a discount and some severe undervaluation. Growth also gets a B+. These are the things that we want to see. It does look like the majority of these have been overreacted by the market. They are growing faster than the sector median, and we also like the profitability at an A+. Their cash from operations looking very strong as well, 640 million versus 237. In terms of the dividend safety, very important as well, especially for those that do pay a high yield, does sit at 80 safe. And when we do take a look at dividend yield theory, again, undervaluation, and the same to be said based on the forward P to AFFO. So let's jump into the intrinsic value. Bear in mind as well, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for this REIT or any others, or in fact any company as well. So jumping into the margin of safety at 10%, a buy at $46, at 20%, pretty much around where we see it now, not quite at 25% level just yet, but actually like some of them today, 20 to 25% MOS, with Wall Street 16% upside, their price target end of year sitting at $46. We then move on to Alexander 500 real estate equities down 23% over the last year. Over the last 10 years, down around 4%, trading at the lower end of the 52-week range. A strong buy from Seeking Alpha, a buy from Wall Street with a yield sitting at 5.41%. When we look at their earnings, only one of the next four they're expecting growth, and over the last four, they've been either in line or beaten 3 of the 4. Nice to see the most recent with their forward P to FFO for 2025 sitting right now at 10.6. Valuation, they do get a C. When we do take a look, we actually notice again this one is trading at a discount to the sector, 14.4% to be exact. Their growth does look good with an A overall rating. However, on a 3-year basis, it has declined. Over the last 5 years, pretty much sitting in line, but what is very nice to see that both on a forward-looking over the next 12 months and just over the last year, they do come in considerably higher than the sector comparative. Profitability also good with a B+, and we do notice the cash from operations sitting in the billions, well above the 237 million. Another dividend safety score sitting at safe with the 76, and we can also see not only a severe undervaluation, but that yield of 5.4, the highest offered over the last 5 years, and the forward P to FFO not just well below the 22.6, but again the lowest offered over the last 5. Again, these are companies with some severe undervaluation, which is why we are flagging them in today's episode. In terms of the valuation aspect itself, well, we pretty much see around 20% MOS with Wall Street, 24% upside, a $121 price target. So a lot of these companies are very attractive, but as always, do give us your thoughts below. We then move on to Rexford Industrial, hammered 29% over the last year. Over the last 10 years, however, it is up 124%, trading towards the 52-week low. Double buy from both Seeking Alpha and Wall Street, a yield around 4.4%. We do like the fact that nearly green right across the board, a very good signal here, and the forward P to FFO sitting at 15.5, maybe one of the highest ones we have seen so far. Now, valuation, they do get a D, again, depending on what valuation metric you do look at, but we do like for REITs in particular, and it makes sense to use the P to FFO, which actually for the first time today, we are seeing this trading at a premium of around 31%. In terms of growth though, maybe it is warranted. They get an A+, looking very strong, double digits, maybe the only one we will see today, in fact, on a historical basis, and both on a forward-looking and just over the last year, looking very good in the mid to high single digit, which is well above the low single digit of the sector comparative. Profitability, they get a B-. Nonetheless, cash generated from operations still looking very strong, more than double when we do compare it to the sector overall, and dividend safety looking very safe with an 81 score. In terms of dividend yield theory, again, not only above, but the highest yield they've offered over the last 5 years, and the valuation, the lowest it has been over the last 5 as well. So what about the actual intrinsic value? We get to $51, and as we can see again, we are talking at least 20% MOS. In fact, pretty much around the 25% at the current trading price, with Wall Street themselves giving this 26% upside, $49 price target. We then move on to Public Storage, down 2% over the last year. Over the last 10 years, up around 43%. We can see all-time highs though, nearly 3 years ago at $409. Trading towards the lower end of the 52-week range. One buy from Wall Street with a yield of 4.13%. And when we do take a look at their earnings, growth is anticipated over the next 4 quarters. However, 50% historical track record, and their forward P to FFO does look a little high in comparison, as we will see at 16.8. So that is why we see a valuation of C-. In fact, when we do compare it, very similar to Rexford, it is trading at a premium right now of around 30%. And in terms of whether or not it is warranted, while growth they get a B, double digit on a historical basis over the last 3 years, high single digit over the last 5, and we do notice pretty much mid-single digit over the next 12 months and over the last year anticipated. So whether or not you believe that is warranted, something to consider. Profitability A+, cash generated from operations very strong at 3.15 billion. So in terms of their dividend safety, 96, very safe score. And we also notice the undervaluation on dividend yield theory, as well as the valuation based on this model. So in terms of PSA and the margin of safety that we are seeing today, you are looking around the 15%, around $286. With Wall Street, their price target $345. They still see some very attractive 19% in 2025. We then move on to Stag Industrial, down 12% over the last year, up 21% over the last 10 years. we can see all-time highs pretty much back end of 2021 at $48. Also, one thing to point, similar to Realty Income, they do pay every single month, trading right there towards the 52-week low. Double buy from both Seeking Alpha and Wall Street with a yield of around 4.5%. When we do look moving forwards, looking very good, green across the board. Over the last 4 quarters, at a bare minimum, they have been in line with the forward P to FFO for 2025 sitting at 13.4. They get a C on the valuation grade. When we do compare it, they're trading pretty much around a 7.8% premium, so not particularly high. And then we can see their growth does sit at a B+, and we do in fact notice both on a historical basis as well as over the next 12 months, it is sitting higher than the sector comparative. In terms of profitability, they get an A-, pretty much around double the cash generated from operations over the last year than what we can see from the sector median. But we do also need to point out the dividend safety score today does sit at borderline safe. We also notice the yield marginally higher than the 5-year, as well as the P to FFO marginally lower than the 5-year 17.8. And similar to how we just ran through for Vici Properties, in terms of the borderline safe score, we want below 5 on the net debt to EBITDA for industrial REITs. Pretty much straddles around that year on year, but nice to see anticipated over the next 12 months to come down to 482, which should hopefully help that dividend score go into the safe region. In terms of the valuation, we get to just under $40, which again will give a fairly nice margin of safety, not at 20% level just yet, somewhere around the 15% point. And remember, pays a dividend every month. Wall Street themselves see $41 price target, translating to 22% upside in 2025. We then move on to extra space storage, down 1% over the last 12 months, up 124 over the last 10 years. As we can see, all-time highs back end of 2021, $226, trading at the lower end of the 52-week range. A double buy from Seeking Alpha and Quant, a yield of around 4.4%. And when we take a look at their earnings, they expect 3 of the next 4 to be growth with a 75% track record. Forward P to FFO currently just under 18. Again, another one that is trading at a premium, hence the C valuation grade. And when we do take a look at it specifically versus the sector comparative, you are paying around 30% more. But again, some companies are worth a premium. In terms of growth, they do get an A, although bear in mind, we can in fact see over the next 12 months, a decline is anticipated against the sector of 1.5%. In terms of profitability, they get a B, 1.84 billion above the 237 million. And when we take a look, dividend does look good in terms of the safety at an 80 score. And we can see that double undervaluation signal on both yield as well as the forward P to AFFO. So let's get straight into the MOS, where in today's episode, we do in fact see around a 15% point, and Wall Street fairly bullish, upside of 16%, their price target $172. And as always, do let us know your thoughts below. We then move on to Prologis, down 17% over the last year, up 137% over the last 10, trading at the lower end of the 52-week range. A double buy from Seeking Alpha and Wall Street, 3.64% yield, and their earnings do look fairly good, nearly green right across the board. However, once again, this company, like others we have looked at today, does trade at a premium. Valuation, hence we do get the D-, and for those that want to see how much, well, this one is on the upper end of around 62%. In terms of growth, A does look fairly good, 9% over the last 3 years, 8% over the last 5. However, over the next 12 months, it is anticipated to decrease by around 2%. In terms of profitability, it does get an A, maybe one of the best we have seen today in terms of cash generated from operations at 4.65 billion. We also like the fact that dividend does look to be safe with the 61 score, and we also get that double undervaluation yield right now, 3.55, higher than the 5-year of 2.61, and valuation also looking lower than the 5-year rolling. In terms of the valuation, well, our intrinsic value, $129, does in fact give today not the 20% MOS just yet, but you are at least getting up to at least $110, 15% MOS, with Wall Street pretty much a price target of where we the intrinsic value, 19% in 2025, $129 price. We then move on to American Tower Corp, down 14% over the last year, over the last 10 years, up 76%, trading right there towards the 52-week low, a hold from Seeking Alpha, a buy from Wall Street with a strong sell from Quant, and a yield sitting at 3.7%. In terms of their earnings, well, the next quarter they are expecting large double-digit growth. However, out of the last 4, they have missed 2 of them, notably the most recent quarter. And we can also see, based on the forward P to FFO of 2025, a bit of a premium. Hence, we do see here the devaluation grade, and we can see maybe not the largest of around 13.4%. We do like the growth grade at a B-, although it is only marginally higher when we do look at the last 3 years and the last 5 years, and pretty much over the next 12 months, very minimal growth, although that is something that we do expect also across the sector. In terms of profitability, A-, very high cash generated from operations, 5.2 billion, with the sector, as we have said, around 237 million. Dividend also looks to be safe. We also get that double undervaluation signal, yield higher and forward P to FFO sitting lower. So when we do get to the valuation in today's episode, you are getting a fairly attractive margin of safety, pretty much at 20% right now, with Wall Street upside 26%, $226 price target. And as always, do give us your thoughts in the comments below. Maybe you're adding to some of these 10, maybe you have already added, maybe in fact you're considering a ETF that covers exposure to real estate like VNQ, or for whatever reason they don't fit in your overall portfolio. Don't forget as well to sign up to the free weekly newsletter, grab those spreadsheets, come and join us as well in the Patreon where we do cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.